How does a DCFSA work? Enrollment in a Dependent Care Flexible Spending Account, or DCFSA, is easy and reimbursement is simple. So how does it work? If you are eligible, you enroll in a DCFSA during the federal open enrollment season. When you enroll, you are authorizing your employer to withhold a specific amount from your paycheck each pay period. These funds are deposited in your DCFSA account for you to claim for eligible dependent care expenses. You have options for using the funds in your DCFSA account. You can pay your dependent care provider directly and submit a claim for reimbursement, or you can request that the DCFSA pay your provider. Regardless of which option you choose, you will need to complete a claim form and attach valid receipts for each eligible expense. For each calendar year, the maximum contribution allowed for a DCFSA is $5,000 per household if you are single, head of household, or married filing a joint tax return. The annual contribution limit if you are married but filing separately is $2,500 for each calendar year. The minimum contribution for all enrollees is $100. As mentioned earlier, you can choose to enroll in a DCFSA during the federal open enrollment season. That occurs in mid-November through mid-December of each year. Or you can enroll or change your enrollment when you experience a qualifying life event, or QLE. Examples of QLEs include the birth or adoption of a child, a change in marital status, a permanent change of station, or PCS, or a deployment. It is important to plan carefully, as contributions may only be changed during open enrollment season or when experiencing a QLE. Enrollees should carefully estimate the amount of dependent care expenses expected in order to decide how much to contribute. Once you decide how much to contribute to your DCFSA per pay period, this amount is then deducted from your paycheck before taxes, and contributions are deposited into your DCFSA account. You may then use these funds to pay for eligible dependent care expenses. It's important to note that DCFSA funds are use it or lose it. This means that any unclaimed funds in your account may be forfeited. However, you've got some extra time. You have until March 15th of the following year to incur additional expenses, and until April 30th of that same year to submit all claims. To help you better understand these important deadlines and timeframes, we have outlined a sample 3-year timeline. Year 1 will indicate the year you decide to enroll in your DCFSA. Enrollment will take place during the federal open enrollment season, which occurs in November through December of that year. It's important to note that enrollment in a DCFSA is required for each year that you choose to participate. The next year, identified here as Year 2, begins January 1st, just after open season. This is when your funds become available in your DCFSA account. They are distributed after every pay period. During the year, you can only change your enrollment if you experience a QLE. A great feature of a DCFSA is that you can continue to use your account for expenses into the following year, identified here as Year 3. Expenses can be incurred through March 15th of Year 3, and claims can be submitted through April 30th. However, if you have any funds remaining in your account after April 30th, those funds will be forfeited. When it comes to contributions, it's important to plan, consider your budget, and estimate your anticipated dependent care expenses. Estimating realistically is crucial to avoid over-contributing and potentially forfeiting any unused funds at the end of the plan year. To learn more, be sure to check out Military OneSource and the Department of Defense's Office of Financial Readiness Resources for more information about DCFSAs. Tax professionals and personal financial counselors are available free of cost to service members and their families, and can help you determine if a DCFSA is right for you.